That's what everybody wants to know. You sit with Hollenhorst over a Starbucks coffee in the morning and you say, where's the terminal rate? Where's the new Citigroup terminal rate?
Yeah, we have the terminal rate now at 525 to 550 and getting there by the May meeting of 2023.
Why is Bullard wrong when he talks about 7% X number of days ago?
I mean, he might not be wrong. He's been kind of a leading sign for the Fed this year. And I think it's fair to think that the rate needs to get to anywhere from 5 to 7.
But the lag effects, not to channel Leo Brainard here, but there is a question of how much companies are already feeling a lot of tightening, and they're ratcheting back their plans for next year and may have to really cut some staff. So from your vantage point, how do you dismiss that as a relevant factor for the Fed?
I think that is very relevant, though. I mean, we're anecdotally hearing that people are cutting back now, but you really haven't seen it in the data yet. And that's really what's going to be most important for us, most important for the Fed, is just what are you seeing in the inflation data, and then also importantly the labor market data. And we still have really low initial jobless claims. It still seems job openings are high. And there's not enough loosening yet. But
this is the important point when you talk about tech layoffs. And we've talked extensively. We've got Amazon cutting 10,000 jobs. You have Twitter, of course, its own story. You have Meta cutting thousands of jobs. How much do you look at this and say it's a tech story, and it's a tech story that could deepen, but it's tech isolated?
Yeah, I mean, I think it's fair to see, first the weakness in sectors like tech or real estate. Of course, the housing market would be most affected first by rate hikes. But eventually, you probably do see it broadening out to the rest of the economy. We think we see that really, as we're getting into 2023.
When you talk to your markets people, how do they link the Hollenhorst Clark analysis into what the stock market will do? That is part of economics, even at New York University.
Yeah, no, it absolutely does matter. And the story of the last year has been, of course, higher rates. That's tighter financial conditions, lower equities. The last couple of weeks, after CPI, maybe we've reversed some of that. But I still think, the momentum is maybe, risk assets still lower.
What does investment do?
Business investment next year.
11% of the economy, 15%?
Yeah, roughly. I mean, it should be slowing, and we've already seen that, of course, in any housing-related investment. That was very weak in Q3 GDP, should be weak again in Q4. But yeah, eventually, especially given that goods demand has come off, you should see businesses pulling back, less manufacturing activity, that type of thing.
And this is a segment where we go into housing, and Tom talks about how he expects something more significant, and a lot of people are saying, yes, that seems to be the most logical conclusion from a 7% mortgage rate, and other people saying no because of just the behavioral aspect of this, which we were talking about earlier. People are going to stay put. There's going to be less mobility. If there are fewer homes for sale, you're not going to necessarily see the realized price declines. How do you game that out in this controversial moment of really historic weakness for the housing market?
Yeah, I think there is still more weakness to come. But yeah, it will matter, what's happening on the supply side, where you do get this pullback in construction also. And so there's less housing stock, and maybe then prices don't fall as much. But what we have seen so far is that home sales are falling, construction's falling, and prices are also falling.
But could you see a real route, not necessarily akin to the 2007-2008 leverage-fueled destruction, but something more significant after the bid up that we saw during the pandemic, and then the Dallas report, the Dallas Fed report, that really highlights how it could spiral, especially as people get less optimistic about how much their homes are worth?
Yeah, I wouldn't expect that we're in a 2008 type scenario. That was a pretty housing specific bubble that popped. But of course, housing is weak, and it tends to be somewhat of a leading indicator for the rest of activity. But I think more what's happening is housing is just the first to feel the impact of Fed rate hikes, and eventually you see it in consumption that's slowing down, other business investment that's slowing down, people losing their jobs. But it's all coming back to that what the Fed has done.